In early 2020, the British rail network came to an almost complete halt. Passenger numbers collapsed and the system effectively froze. To keep essential services running for key workers, the Treasury intervened, pumping £8.3 billion of emergency funding into the network. Yet, in that same year, an £822 million dividend flowed out of the UK rail network to a holding company in Jersey. This was paid by Angel Trains, one of three rolling stock companies, or ROSCOs, that own most of Britain's 11,000 passenger vehicles. We are currently watching the end of 30 years of rail privatization. Franchises are returning to public hands. But that renationalization does not touch the ROSCOs. The architecture above the operations is being left exactly where it was put in 1996. Centralizing the operational side of the railway without addressing who owns the capital leaves the state subsidizing an offshore monopoly. These three companies are not British in any meaningful sense. Eversholt, for example, is owned by the Hong Kong conglomerate CK Hutchinson through intermediate vehicles in the Cayman Islands and Luxembourg. Porterbrook and Angel Trains have similar overseas consortiums. To finance the trains, they raise capital on bond markets at standard institutional rates. That money flows down to their UK operating subsidiary, but then parent companies lend that money onward to their UK subsidiaries at internal interest rates around 7%. By charging themselves high interest on these intragroup loans, they push profit out of the UK tax ring fence and into higher-up holding entities where the tax treatment is significantly more favorable. This is standard multinational corporate structuring. Over the last decade, Eversholt alone paid £424 million in interest to its overseas parent through intragroup loans. When applied to an essential national utility, this mechanism legally transforms public subsidies and captive commuter fares into tax-advantaged corporate interest payments. The public face of this system has always been the train operating companies. These are the franchised brands you see on the platform. By contract, operators pay fixed lease costs to ROSCOs, regardless of passenger numbers. So when demand vanished in 2020, the Treasury's £8.3 billion bailout flowed straight through the operators into the ROSCOs. They never shared the pandemic risk. Their lease payments were guaranteed. Because they were insulated from the collapse, the three companies distributed £950 million in dividends to their overseas parents that year. That is exactly where Angel Train's £822 million Jersey dividend came from. The architecture operates on a strict asymmetry. The state completely absorbs the systemic risk of collapse, while the capital owners capture the financial upside. To understand why this structure survived the current wave of renationalization, we have to look at how it was created by John Major's government. Between 1995 and 1996, the physical trains of British Rail were bundled into three portfolios. They held a book value comfortably above £2 billion, but were auctioned for a combined total of around £1.8 billion. In 1998, the National Audit Office concluded the taxpayer was shortchanged by at least $700 million. The proof was immediate. Porterbrook was bought in January 1996 for £527 million. 7 months later, it was flipped to Stagecoach for $825 million. Sandy Anderson, who led the Porterbrook management buyout, put in £120,000 of his own money. He walked away with over $36 million. Over the next 3 decades, the operating franchises proved replaceable. Some went bankrupt, others were taken back into emergency public control. The operators came and went, but the ROSCOs, once sold, were permanent. The Treasury accidentally gave away a public asset at a heavy discount, watching the secondary market correct the price and establish a highly lucrative, unbreakable architecture. The 2024 Passenger Railway Services Act dropped the pretense of the franchise model, allowing the state to absorb each remaining operator as its contract expires. Southwestern Railway was the first deliberate use of those powers. By 2027, the Railways Bill will consolidate this under Great British Railways. It will become the unified national operator, directing track, train, and ticketing. These operational gains are real, but the trains themselves are not being renationalized. The rolling stock companies are untouched. Great British Railways will simply become the single lessee. From the perspective of the ROSCOs, leasing to a single, massive, state-backed entity marginally improves their own credit position. While the government has discussed using cheaper, non-profit European financing vehicles for future train procurement, this does nothing about the 11,000 vehicles in the existing fleet. Centralizing operations solves the daily friction of delay attribution and ticketing, but it cements the extractive leasing model sitting above it. A commuter buying an annual season ticket from Tunbridge Wells to London terminals hands over more than £6,000 a year. Under the current reform, that commuter will likely see her trains run a bit more smoothly over the next few years. At the same time, her ticket price and taxpayer subsidies will continue to flow up the chain to offshore parents. For decades, the political class has tacitly agreed to fix the visible layer of the railway, the delays, the franchises, the ticketing, because the political costs of operational chaos are obvious. The deeper layer is left alone. Unwinding 30 years of offshore rentier structures requires sustained political attention and a willingness to take on well-resourced financial interests. So far, there is no appetite for that confrontation. Operationally, the railway is coming back into public hands. Financially, the part of the railway generating the most reliable returns is staying exactly where it is. The physical trains are coming home. The ownership has further to travel. The financial core of the British rail network remains a guaranteed, risk-free yield for overseas investors.